Hello, welcome to our FX Quarterly for May 2025. It's a webinar hosted by me, Taimur Baig, Chief Economist, and I'll be joined remotely by Philip Wee, our Senior FX Strategist, as well as Chang-Will Young, our FX Strategist, plus Crypto Maven. We will also have our summer intern Joshua sitting in through this call. The webinar will cover key asset classes, basically with respect to FX, but across geography and across the US dollar to interest rates to crypto nexus as well. So not just FX, but the broader asset class view embedded in our FX forecast. So without much ado, let's just get going. We will start with Philip, followed by Will Young, and then we'll take some questions to those who sent it during the WebEx call. Enjoy.
Okay, thanks very much, Timer. Thank you everyone for dialing in. We just released our quarterly last week, and we've sort of straightened out our forecast. So today I'm going to explain to you why we've decided to plot a straight line over the next couple of years with regards to the dollar's downtrend. Okay, William, next chart, please. Okay, when we started the year, we were actually looking for the dollar to reprice its haven status, because we were expecting the tariffs to be pretty harsh, especially for Asia. While that call was correct, but if you look at the performances, let's say in this chart, take the middle, you can see that when the tariffs came during the first week of liberation, after Liberation Day, most currencies actually drop. So Swiss and yen, were the haven currencies. However, after the 90-day pause came, you can see that most of the currencies have rebounded very strongly. So we asked ourselves why was this the case? Then it occurred to me that Trump is trying to compress 2018-19, the U.S.-China tariff war. He's probably learned, from back then, and he wants to expedite. He just wants things quick. So he's using tariffs as an escalate to de-escalate, policy to push through as much trade deals as he can by July, and of course, including China in August. So this would bring us straight, into the January 2020, when we had a phase one trade deal, when the market was already positioning for a weaker dollar. But because of the COVID recession, the dollar went up first. But nonetheless, I think this is where we are in terms of the tariff story. Next slide, please. Sorry, the previous slide, please. Okay, my apologies. Next slide. Yeah. Okay. But as we were reworking our forecast, we realized that the policy making of Trump and his administration. I mean, we are all focused on his erratic on and off comments on tariff, but when you strip them all down, we realized that he was undermining all the pillars that underpin the dollar's credibility and status after the Second World War. For example, the U.S. economy, Fed is now looking at a situation of inflation, leaning more towards stagflation. But I think we all agree that it's not going to be exceptional as last few years. But more importantly, the institutional trust which investors rely on in holding their dollar-denominated assets were being chipped away. Namely, the Fed's independence, and of course, right now we're going into the discussion about the unsustainable federal debt and, of course, the fiscal deficits, and that will be followed by deregulation risk, which I'll touch on in the next slide. And of course, US, has been the champion of the global good. So, but Trump has sort of changed that into US being a transactional negotiator, especially in tariffs, hitting both allies and rivals alike. So that has eroded, the global trust in the US. and of course the geopolitical leadership that we have relied on. For example, Europe doesn't have the peace dividend anymore, and we have political interference in German elections and imperialistic ambitions, talking about Canada and Greenland. So, but on the tariff side, I guess the biggest concern is that after the Second World War, the world sells exports to US, earn dollars, and put it back, into treasury. So it raises the question, as to whether this hard-handed approach to fixing trade imbalances is going to open cracks, in terms of the post-World War II recycling system that financed the U.S. deficits. Okay, so for us, we decided, to push the DXY forecast down towards the 92 by the end of 2016. Okay, next slide, please. Okay, so so now, okay, I'm not going to run through it all, but generally, Trump is trying to achieve everything. The tariff policy, with trade deals by July, August. And of course, I think for some of the Asian current countries, there's always this thinking that he will want currency appreciation. So that's probably one factor that will underpin the Asian currencies. Then next, which is running side by side at this point, lots of focus on the 30-year US bond yield as well as the 10-year bond yield, where the Moody's removal of the US final AAA rating has raised concern about the sustainability, the long-term sustainability of US debt. Okay, so lots of estimates going out there, that he may add between 5 to 11 trillion to the federal debt. So Moody's itself has raised the debt to GDP forecast, I think, from just below 100% of GDP this year or last year to about 135% by 2035. So, but we also remain mindful that S&P has said before that, if America gets into brinksmanship again and continues, long-term unsustainable fiscal path, they may consider, axing the debt rating again. Okay, so that's something to watch. And of course, after the first two is done, Treasury intends to take a stronger role in terms of bank regulation. We have seen in Trump 1.0 that they've done the same, but they freed up mostly on the front end, and that resulted, I think, in the Silicon, or was partially responsible for the Silicon Valley Bank crisis. So, but more importantly, I think for most of us, is that Powell's term is coming up in May next year, and that raises a lot of, I think, anxiety with regards to the Fed's independence. Okay, I'm going to speed up from here. Next slide. Okay, so I think the best way to show the concern is really the percentage share of allocated foreign reserve. You can see that during Obama's time, Obama has spent, I think, his two presidency bringing the U.S. economy back from the global financial crisis. So in the second term, dollar share of world allocated foreign reserves actually increased. And you can see very clearly that it was during Trump 1.0, when he was doing the same trade deficit and bank deregulation policies, that the share has dropped substantially, to the point in 2020, I think there was a lot of concern about the dollar losing its reserve status. Quite interestingly, in the past week or so, ECB, has not been too concerned about the euro's appreciation from 102 to about 114. So, so in fact, ECB seems to be sees an opportunity, for the euro
Hey,
to
Philip,
become. Yes.
I just want to make one observation and tell me what you think. So, yes, we are seeing a secular decline in foreign
Mhm.
reserves share allocated to the US dollar. But at the same time, the period that you're showing, the last 10 years, we've seen more than doubling of gold prices. So, if I were a central bank, just the valuation effect of me having gold on my reserves would by definition increase my gold share of my reserves and decrease dollar share of reserves. So, some of that is also in play here, correct?
Mm-hmm. I think the goal, the last time dollar sing is trying a new low. We are not there yet, but gold was also at a record high. So gold, I think by extension, I mean, given that the current dollar that we have is the product of the end of Bretton Woods. So I think for myself, like this, I have this personal view that you know why do we have more and more financial crisis over the last half a decade. I think one big reason is the end of the Bretton Woods. As far as I'm concerned, in the past, most exchange rates were fixed, and to go, so they had to maintain discipline. If not, they had to devalue, their currencies if their government want to spend. So this is where I think this is where gold is highlighting, the challenges of the post-war reserve currency system that is led by the US dollar. Uh, would that be okay? Can I move on?
Yeah, please do.
Okay, next slide, please. Okay, let's go on to the next slide. Okay, so so it's quite interesting that Lagarde came out because when I had this set of slide, many questions were asked. So if the world, reduces the exposure, no one believes that the dollar will lose its dominance. Okay, because the dominance is not in the trade side; it's really in the financial markets, where stock markets and outstanding bonds in the world, each class is above world GDP. Whereas world trade is about half of world GDP, but US share is about 40 to 50% in both. So dollar dominance is entrenched at the moment, but this does not mean that the dollar cannot go down. So but the question is always which is the currencies that people can move into. So I think euro has traditionally been the second largest. So um, and it's quite interesting to see Lagarde coming out, promoting the euro, becoming a prominent currency again. So and this time around, unlike the last few years, where Europe has been struggling with a stagnant economy, especially in Germany. But ironically, after Trump pulled out the or ended the peace dividend, after on his desire for Ukraine, Russia, to find peace, then so that has pushed Europe, to come up with its own stimulus plan, through the Readiness 2030 initiative, which actually has been, I like the old name better, the Rearm Europe plan. Okay, where this time they have opened the door for stimulus, to help them counter this tariff um, pressure from tariff. Uh, and the ECB has also managed to cut quite substantially compared to the Fed. So all in all, Europe may be in a better position to cushion itself. So, and I think they are nearing the end of their cutting cycle as well. Okay, so next slide. Okay. So on the next slide, I just want to highlight, that we have noted, that the net long euro position is no longer negative. It has turned positive. In the interest of time, I just want to say that we do think that there is still uh, room for the speculators to bring the net longs to higher position. one of the reasons why we have put our forecast at 115 to 120 over the next 1 to 1.5 years. Okay, next slide, please. Okay, for sterling, pretty much the same story, but but in terms of growth story, I think sterling now, it's not that it's a wonderful growth story. It's just that the US is not exceptional anymore. Then and UK was the first country to achieve a trade deal during this 90-day pause. Okay, but but we are monitoring more also, that progress that UK and EU are making towards, I think, um, a more collaborative post-Brexit relationship. So Brexit has been blamed, lots of time on, the sorry state of the UK economy, and of course, now that the Tories are not in charge after 14 years, there's more of a semblance of political stability as well. But nonetheless, I think we do see the window opening, on the back of the dollar for sterling to revisit the 140 level again. Okay, next slide, please. Okay, so pretty much the same story as the euro. Okay, so sterling we have seen it's very fascinating. I mean, in the sense that their strength is really driven by their net longs, so it's been always sort of consistent. But this time round, the rebound has been stronger, despite the positions still, positive, but still low. But like euro, we think that it has room to keep to build up. Okay, so on the right hand side, I think uh, the biggest concern is how much momentum um, can build on the long side, and that's where we really like to see, the sterling bulls come in to underpin our call, for sterling to uh, push above 135 towards 140. Okay, next slide. Okay, the Australian currency was one that we were quite concerned about um, on the Liberation Day tariffs. So we thought that it could have broken into the lower half of channel, which it did, but very briefly. Okay, so but because, as I mentioned earlier, the tariff is really about moving quickly to trade deals. So, and this has sort of underpinned Asian currencies pretty well. And the next slide, I'm going to show you why this has been quite important for the Australian dollar. Okay, so and at the same time, now that US has lost its final AAA, Aussie, is also one of the remaining AAA rated currency, just like the Singapore dollar. So I think going forward, um, the RBA is also not as forthcoming as it was in the last, I think, couple of meetings with regards to delivering more rate cuts. So you can see that the markets have pulled back quite substantially the number of rate cuts that they have been pricing for this currency. But the real story is really on the Asia side. Okay, so you can see from this chart that almost 3/4 of Australia exports head to Asia, and more importantly, to the big three in Northeast Asia. So Japan, China, South Korea. So we have seen dollar yen pullback. We have seen dollar China starting to win off from the top, and Korea has also corrected quite nicely. So this, I think, has been uh, very strong factor underpinning the Aussie, as you can see on the right. So I've always considered the Australian dollar sort of a proxy Asian currency index. So it mirrors quite nicely this basket that we have sort of built against this currency. Okay, next slide. Okay, so for dollar yen, I'm not going to talk much. Wei Liang will be covering. I just want to highlight on a technical basis that we will be looking at the 140 level quite closely for a break, to push lower towards the 130. So as you can see from the chart here, so that's pretty much the view that we'll be looking for. I'll be letting Wei Liang to elaborate more. Next slide. And just to quickly highlight on the speculative positions, yen, you can see from the net, positions move from being funding currency of carry trades last year, and now pretty much moving on its own, more as a haven, against the dollar weakness. And also, if you look at the right hand side, the long and the short, you can see, what I've just described being reversed, quite strongly. Okay. Next slide. Okay, so on the renminbi, just want to touch very briefly because I think we're going to be covering too. Just want to highlight that this currency has become quite unique since mid 2023, mostly in the range of 7 to 735 so far. So we have decided to put the forecast into the floor, which is about 7. Previously, we had it nearer the 710. Okay, so next slide. I think what we want to highlight is that China is very different today compared to Trump 1.0. Okay, so where they were literally, just reacting to the tariffs. This time they seem to have a much clearer strategy, and they have demonstrated this, by hammering back more than 100% tariff on the US. So, and now both sides have entered a sort of truce. But you can see from the chart here, all the tariff rates that are put in, that the long and short of is that ever since China's new governor Pan Gongsheng came in July 2023, the spot and the fixing is not moving together anymore. And so the central bank is actually allowing the currency to fluctuate more in the upper half of the band during times of stress, or when they are buying, or when he wants to buy bonds. So, and of course during the tariff, you can see that when it's being dialed up, it moves up to the top range, and now it's sort of come back down to the fixing. So we're paying more close attention to the fixing. We noted that last September, dollar China actually came down to the 7 handle level. That's pretty much on the Fed cut. So Fed cut is quite an important story. Fed's officials so far seems to be indicating that the earliest that they can cut is probably in September, after they get more clarity on the trade policies as well as fiscal as assumed after the 90-day pause. Okay. Next slide. Okay, so just want to share with you that we've been experimenting, just looking at correlations, between the dollar. Let's say for China here, I'm using China currency pairs, looking at against the big dollar index, and then stock, how it's been performing against the stock, and 10-year differential, and of course on the debt side, using the 5-year CDS. So roughly, just correlate, running through very simple regressions from the start of 2024, it gives you some levels that like 720, like what is a sort of fair value if you're looking at Shanghai Composite Index for this period is 729, then 724 if you're looking at the 10-year differential, 722 5-year CDS, and and 714 if you're looking at the DXY. And of course this is a moving target, because if all these markets move in the same direction, the dollar China rates will move accordingly as well. Okay, next slide please. Okay, I think I'm going to try, I might just finish up with the Sing and then let Wei Liang take over. Okay, for the Sing, okay, Singapore the Sing dollar is always a price taker. So, most of the time it's correlated um, with the big dollar index, but not on an index basis, but it's just optically, okay. But I think the big question now is that with the weaker dollar, dollar Sing is or has been close to the 128 that we saw last year, after the Fed into the Fed's 50 basis point cut. Yeah, so and in the past month or so, there's been a lot of excitement at our side. Many people were asking, how low can dollar Sing go because of some media report about dollar Sing could hit parity against dollar over a longer term. So sorry. So um, So we never like to jump the gun about parity. We thought, it'd be more useful to just highlight all the lows, that lies ahead. For example, 123.60 is the July 2014 low. This was when Asia was still positive before the currency war, and Fed was still dovish, with QE. Then we had 122, fourth quarter of 2012, right after the EU crisis, where the Fed came in with QE3 to help. I believe that helped the euro to stabilize quite a lot. During that period. Then of course the all-time low was 120 in August 2011. Um, this is when the Sing was sought as a haven. um, I think interest rates were negative in Singapore. Gold was at a record high, just like what we are seeing today. And US also just lost its first AAA debt rating, due to a debt ceiling fight, and of course the dollars uh, entered into a confidence crisis. Sounds quite familiar, right?
Yes,
So
Philip, I cannot
yes.
let you off the hook. Might as well
Yeah.
ask you. All right, we see
Mm-hmm,
your forecast, that's fine, but
mm-hmm,
that's your central forecast. What is the
mm-hmm.
probability of Sing dollar going to 120 by the end of this year?
I wouldn't say it's low, so it's something that at the back of my mind. But as I think we had this conversation this morning, as I mentioned, still need to see key levels break. So I really need euro to move above 115. But we're still languishing around the level, and dollar Sing has bounced off, I think, the 128 this morning. So and we sort of recognize that it's quite challenging, this environment. While the dollar, has credibility issues, we can't ignore the fact that U.S. interest rates are still high, so the carry is against you. And at the same time, there's always, why is we still do not know how the trade deals are going to pan out. So still lots of uncertainty ahead. So, but certainly, that if we do move into, let's say, if Trump, after everything, decides to move into a Mar-a-Lago kind of situation, then yes, we have to think about, the 120.
All right.
Mhm.
Thank you very much, Philip. So we take, let
Uh,
William take over now.
let me just finish off with the Singnia. Okay, just very quickly. Okay, just to highlight, the interesting thing about the Sing is that when people ask me, why is the Sing so strong? I said, well, you should look at the Singnia. We had two easing in January and April, and the Singnia is now at the record high. In fact, given the forecast that the official forecast that we have for GDP growth at 0 to 2% and core inflation at 0.5 to 1.5%, it should be closer towards the mid rather than 1.3%, higher. So this is also another reason why at this juncture we are, while we are negative on the dollar, we are also aware that currencies may be stretched, and central banks may also not want to encourage one-way bets in the currencies. Okay, with that, I'm going to hand over to William.
Very, very interesting. All right, William, take over. But I think there's a question also we have to take care of. You want to do that now or you want to do it at the end?
We can do it towards the end.
All right, go ahead.
Okay. All right, thanks, Philip. So, bearing in mind time constraints, I'll try to keep my section on North Asia short and sweet. I think the first point to note about North Asia is that many economies are quite vulnerable to tariffs. A lot of them are major exporters to the US. So if you look at the share of exports to the US, they all lie on the higher side in Asia. And the second point is that because they are also current account surplus countries, they attract higher reciprocal rates from the US compared to countries with current account deficits. So by and large, we will say yes, they are quite vulnerable. Baseline tariffs 10%. We don't know if reciprocal tariffs will be maintained or not, but at the very least, we could expect some softening in external demand. And if you look at the proportion of trade as a percentage of GDP, North Asia's has very high reliance on trade. Basically, they are all lying on the left-hand side of the scale, with a dependency of between 6% for Japan, as high as 19% for Taiwan. So I would say uncertainty over tariff is still high, even though we have seen a bit of a relief because of the 90-day pause. But somewhat surprising, if you look at the actual performance of North Asian currencies, even though there's so much uncertainty, they have actually done the best in Asia. They have outperformed the INR, IDR. Effectively, they have even outperformed Euro, which is the major alternative reserve asset that's benefiting from all these outflows from the US. So why is that the case? I think there are two major reasons. The first is, of course, to do with the fact that RMB depreciation pressures have eased, and we know North Asia is very much correlated with Chinese cyclical demand. So if you look at our analysis, where we look at correlation of business cycles across all the major economies with the business cycle in China, you could see Hong Kong, Taiwan, Japan, Korea, all they have very high correlation with China. So now with the RMB showing some signs of stabilization, perhaps even some gains in the short term, there's definitely some relief coming through on that front because of the US-China trade truce. So that's helping North Asian sentiment. And the second point I would like to underscore is the fact that actually most North Asian currencies, they are all highly undervalued. So the yen undervalued by as much as 20%, RMB 18%, Korean won 7.5% based on our dear valuations. Very much more than all the other major currencies, including the dollar, sterling, euro, and so forth. So by and large, that undervaluation has also stirred some speculation that we could see some kind of currency agreements in the trade negotiations, whereby North Asian currencies might see some policy guidance towards strengthening. There's still very much speculation at this stage. US Treasury has not made any statements backing away from the fact that the principle of market determination of exchange rates will be upheld. So we think by and large, there's probably not going to be an official currency agreement, but at the same time, North Asian authorities will be very wary of intervening in FX markets, will be very wary of being seen as deliberately weakening their currencies in this kind of tense trade negotiations of the US. So just a very quick description of what is happening between US and China. We did some calculations, that our China economists did some calculations, and the estimated impact on growth in the case of China from all these cumulative tariffs is around 60 basis points. So that's looking quite manageable. We think China could largely offset some of this drag with fiscal stimulus, as well as the fact that there could be some diversion of exports to other countries. So we're not looking at a very significant slowdown in China. So that's good news for the RMB. So for one thing, the RMB has been relatively stable against the dollar, and the dollar has eased quite significantly, not just against the euro, but against most other major currencies. So what that means is that RMB basket index, the trade weighted index, that has fallen quite a lot in the moves since the start of the year. In fact, the RMB CFETS basket index is now tracking towards a 2-year low. So by and large, we think that's a lot of depreciation on a trade weighted basis. There's no acute need for adjustments in terms of having further RMB depreciation. Most of the pressures we think should have abated by now. But does that mean that RMB could, follow a path of Taiwan dollar, see very large strengthening? Again, that's not quite the case because we know that Chinese growth environment is still fraught with risk. There's still a bit of concern of that growth momentum is still quite sluggish. So overall policy bias is still towards easing. So we're not in the same kind of scenario as back in 2010 when our RMB was allowed to gradually strengthen. Because at the time, the PBOC was actually hiking rates given strong demand. Now demand is still weak. PBOC is still cutting rates. They just recently cut the 7-day reverse repo rate. They cut the loan prime rate by 10 basis points. So by and large, because of this easing stance, that will be inconsistent with an RMB overshoot. So we don't think RMB is going to see very sharp appreciation. We're looking at a gradual trajectory for dollar CNY to head lower towards the 710 level by first Q of 2026. All right, moving on to the yen. So yen is actually one of the prime beneficiary of diversification flows away from the US. As Philip mentioned, the dollar has lost a lot of its attractive quality. It's no longer seen as quite as safe as before, given the very uncertain, erratic economic policies being placed in the US right now. So yen has regained some of that status as a safe haven. Is seen as a very much safe alternative to the dollar. So you could see just after the Liberation Day tariffs in early April, there was a huge surge of long-term portfolio inflows into Japan. In fact, it marks previous high seen back in 2024. So that means that actually foreign investors, they're looking to Japan as a potential destination if they're looking to diversify away from the US. So that's one factor that is arguing for some degree of a yen strength coming through in the coming quarters. The second point to note is that in Japan, the super long end yields, by that I mean the 20-year JGB yields, they are rising quite significantly. And unlike the US, the vast majority of bonds in the JGB markets, they are all above 20-year maturity. So the average interest rate on offer in the JGB market has risen quite significantly, even at the same time where there's a lot of question mark over US Treasuries, right? Because of firstly, rating downgrade. Secondly, we have very high uncertainty with regards to the fiscal stance of the US, given Trump's tax cuts that are coming through. So the JGB market is looking somewhat more attractive on a relative basis. That could also see some degree of repatriation coming through from Japanese asset managers away from the US coming back to Japan because of higher yield. So that's another tailwind for the yen. Just one final point on BOJ's monetary policy normalization. For one, yes, it's going to be slower because of all the uncertainty with regards to US tariffs, so on and so forth. But it doesn't mean that BOJ is not going to be hiking rates. So Governor Ueda has come out this morning saying that yes, the baseline still remains for rate hikes, even though they'll be more careful in assessing the timing of the next rate hike because of what's going on in terms of US-Japan trade negotiations. We're looking for dollar yen basically to ease towards 140 by end of 2025. And just one last slide on the Korean won. We are expecting Korean won to outperform. We like the won against a basket of US dollars and euro. Why? So there are a few reasons. The first reason is that the Korean won is very highly correlated with the RMB, with the yen. And as I mentioned, because of US-China trade truce, and also because of the fact that competitiveness of the RMB is relatively strong. We have seen RMB stabilizing, seeing a bit of gains. Yen sentiment is still turning around. So both currency strength should argue for some recovery in the Korean won. So we've seen a little bit of won strength in recent weeks since the release of our FX quarterly publication. And if you look at valuations, actually, Korean won is still relatively undervalued based on our deal. Is definitely one reason why there's a very clear policy preference for stronger won. We see BOK expanding its sword line with the Korea's National Pension Service because the NPS has a constant stream of outflows. Investing into overseas assets, you'll always be looking to buy dollar Korea. Now, because of the swap line, they're not in the FX markets anymore. They're just taking advantage of the swap line. So we see official preference for stronger won coming through. And that's probably another reason why we don't see very extreme weakness in the won, even though the external environment for trade is still quite uncertain. And last but not least, Korea is going to elect a new presidential candidate after elect a new president next week after the impeachment of the previous president. So right now, the polls indicate that the Democrat Party candidate is in the lead. So that's probably a good news. If the DP candidate becomes the next president, it means there will be less political obstruction in the National Assembly. There could potentially be some upside in terms of political uncertainty dissipating, as well as more fiscal support for the economy coming through. So based on that, we think the Korean won short-term sentiment and longer-term valuations are still very supportive of a stronger performance in the months ahead. And so with that, I will pass back to Timer for our Q&A.
William, thank you very much. It's such a fascinating time in this world of currencies right now, as we have been writing for the last few months. When you have high yields and tariff, the dollar should appreciate. That's what we've seen repeatedly in the past instances when the Federal Reserve says tighten monetary policy or keep rates high, the dollar appreciated because the yield differential is in favor of the dollar. When the US has imposed tariff, circa 2017, 2018, the rest of the world's FX sold off against the US dollar. We're seeing the opposite happening. I think both you and Philip have touched on several things, the weaponization of the dollar, the uncertainty around geopolitics. But where this goes is anybody's guess. Looking at the charts that you have shown and the charts that Philip has shown, this movement is still not extreme. It's happened in a short period of time and it's anomalous, but we've seen these levels. I think, Philip, the last time seeing dollar was 120 was but 10 years ago, right?
Yeah, 2011. Yeah.
Yeah. So from a level perspective, I fear there's more to go this is in conjunction with my fear that the trade war issue is going nowhere. Okay, so we have a couple of questions, or at least one question on the chat group. I'm going to read it out to you and to everybody on the call. Feel free to send more questions. Philip and William, thank you for this interaction. A few questions. Thoughts on the yuan status vis-a-vis the greenback. So just build on that a little more if you can. And quick thoughts on the slew of US dollar data that's coming out over the next past weeks or so. CPI, retail sales producer price. What is the significant impact? I'll take that one. And then thoughts on increase of bullions, in the region. So gold-related stuff. Maybe William, you can take the gold question and de-dollarization. I'll take the US data question. And Philip, RMB.
Yeah, sure. So you go first?
RMB, yep.
Oh, you want me to take the RMB first? Okay. I think I've always taken the view that I think China doesn't want to supplant the dollar as the reserve currency of the world. China, by nature, is a saver country. Is a saving country. So, and we all know the dollar, dominance is, we've always said that, US likes to spend, so, but nonetheless, this year, quite interestingly, I think we're starting to detect that China is also starting to tweak, at least its capital account, allowing for more flexibility. Bear in mind that it's still closed. Like for example, I think the new memorandum of understanding that is signed with Bank Indonesia, so it's expanded the bilateral local currency settlement to cover capital and financial account transactions, not just current account and direct investment. So, but this also highlight that China is still taking a very calibrated, very selective approach in terms of opening up its account. But at the same time, it's definitely still pointing in the same direction as what we have seen in the past few years, the path of de-dollarization. But the reality is that most countries, just wants to reduce, the exposure to dollar volatility. So
Philip, one question. In terms of
Mhm.
flows, both portfolio flows and investment flows, are they favorable to the RMB?
I would say that if the RMB, if you look at how it has behaved this year, the just want to highlight to everyone that the appreciation actually didn't start, when with the trade truce. It actually started with the 90-day pause. So I would say that he's pretty much in line with the dollar trend, just that he's not moving as much, as the other major currencies. But in some ways, this makes sense because China has always been trying to reduce its export reliance on the US. So we've always heard about diversification into new markets. So naturally, you will want to keep its competitiveness against the other countries that is hoping would buy its exports. Yeah.
Thank you, Philip. So, William, on the issue of gold, maybe we can discuss it both in conjunction with gold and crypto. The de-dollarization trend that we're seeing, let's take what Philip is saying as the anchor of the argument. Nobody wants to de-dollarize like they don't want to hold dollar, but everybody wants to reduce their exposure to dollars. So you just published, along with a few of our colleagues, our recent crypto quarterly as well, or digital asset quarterly. So what is your sense, both with respect to gold and digital assets, both from a private and public, institutional and central bank perspective, there's this asset allocation idea beyond the dollar?
Right. So we know gold has been rising, and actually that's in very sharp contrast to real rates, which are also rising. So that means that something has changed, right? And what has changed is perhaps the credibility associated with U.S. policy is creating a lot more uncertainty around holders of U.S. Treasuries, holders of U.S. dollar assets, and why that's the case. I think a lot of uncertainty with regards to what's going on in the trade picture, a lot of uncertainty with what's going on in terms of the fiscal picture. So clients have been asking us, with the US downgrade, what does that mean? Right? Does that mean that I should be looking to get out of my US dollar exposure, going to gold, going to crypto? So there's definitely a lot of questions around this diversification trend. We think it's still in its early days because firstly, if you look at the proportion of holdings of crypto in most asset managers' portfolio is really quite low. It's not seen as a typical asset to hold. So there's some scope in terms of increasing allocation that perhaps is also one reason why crypto has really outperformed during this period of time since the Liberation Day terrorists. So with regards to gold, obviously is the default safe haven. The question mark now is how much of that increase in gold is due purely to de-dollarization, and another part of it is due to the fact that the international world order has changed, right? There's a lot more geopolitical uncertainty. Gold is seen as the ultimate safe haven, the ultimate insurance against that.
So even if dollar was not being weaponized, there would have been some rationale to increase allocation to gold anyway. William, I mean, I've seen your digital asset quarterly update. I've heard your presentation. I think there is this view also that this U.S. administration is very pro digital asset. Stable coin might be one more trick up in the sleeve of the U.S. to support U.S. Treasury. That if you allow a huge amount of dollar stable coin to be issued, which are backed by U.S. Treasury, that's one way of absorbing some of the additional issuance demand. And next to that, or in conjunction with that, is the fact that, Trump issuing various meme coins or suggesting there'll be a crypto strategic reserve, or states might even start thinking about holding crypto. All those things seem to suggest to many investors that U.S. is sort of structurally long crypto, which is rather weird because we are worried about debasing of U.S. dollar. It seems like the country that is encouraging that is the U.S. itself.
So I think there's a bit of a libertarian ideology at work here because crypto is seen as something that is a free market of very limited government influence. And we know Trump's administration, their push has always been to cut back government, roll back, all this government involvement. And crypto is perhaps one way that they're thinking of doing that. But at the same time, the stablecoin argument, which is you made, is quite relevant because they really want to entrench the US dollar. They have basically banned all CBDCs. They're not denominated in US dollar. They want to promote stablecoin, and the vast majority of stablecoins in the market is US dollar. So that really entrenches the role of the US dollar, even in the crypto ecosystem, in the digital payment ecosystem.
Yeah, very interesting indeed. I think there was the US data, recent flow of data. So look, the flow of data out of the US right now does not point toward a recession, does not point toward a massive pickup in inflation. Let's be very clear. I'm going to repeat that point. The data that we have so far do not point toward a pickup in inflation or a massive correction in growth. What, however, we see is soft data. Surveys seem to suggest whether it is producers or consumers, everybody's worried about demand. Everybody's concerned about the investment environment. Everybody thinks prices will go up in the future. So expectations are so divergent from the backward-looking data. It is absolutely remarkable. Normally, you would have the backward-looking data give you a pretty good sense of what's the underlying momentum of demand and price directionality. We're not getting that at all. Sentiment, very, very poor toward prices and growth and demand and employment, whereas backward-looking data so far suggests pretty good. We are not in the outright recession camp. We're forecasting 1.5% growth for the U.S. in 2025. I think some of the weakness that in the data that we saw was sort of artificial, something about gold valuation of imports, as well as overall front-loading of imports in anticipation of tariffs, and some of that will probably be given back in the second quarter, and we might see a surge in exports. So it's very, very noisy right now. I think putting all that together for the first half of the year, we might get about 1% growth, and in the second half of the year, we might get 2% growth because there will be a lot of tax cut fueled growth impulse coming into the economy in the second half of the year. But all of this can go very much on the wayside. It really is a function of how this tariff negotiations, the trade negotiations go. You heard at the beginning of the call, Philip say that the UK was the first country to do a deal with the US. But what exactly does a deal mean? A free trade agreement, as those of us, actually, we have a colleague in group research who was part of the Singapore-US free trade agreement, takes multiple of years and thousands of pages of issues to be dealt with, negotiated, and signed in. What we're talking about now is a political level understanding between the UK and the US on a few top level things. That doesn't really form a proper agreement. And so many countries in the world want to do deals with the US, but that's really with Donald Trump in mind, as opposed to sign an agreement with the US, which is with the government of the US, Treasury, Department of Commerce, US Trade Representative's Office, technical discussions. There's just no way in the world that the US government has a bandwidth to do that for hundreds of countries right now. So I remain very wary of the likelihood that we will see a lot more volatility around trade, which might cause a paralysis of investment, which then might compel a significant downgrading of growth expectations for the second half of the year. Not quite there yet, still hoping there'll be some resolution, but if not, all bets are lost and we might be revising down our forecast. All right, one more question. The post-liberation day drop in volatility, is that a window to put on carry trades into EM? Well, Yang, you want to weigh in on this? Carry trade into the EM, and the carry is still kind of US-centric.
So I would say the carry is still not very large for EM because the Fed did cut rates, right? So they're still pretty much on hold. So I would say, yes, there could be some degree of carry, but that would probably be more favorable for the US dollar than.
Right, also carry from where to where? I mean, the yen carry trade, you borrow in yen and you invest in US dollar. I guess that got unwound in the first half of this year because of the cross-currency basis window turning adverse. Similarly, borrowing in euro and investing in the US dollar, same story. Now, could we have a carry trade where we borrow from euro or yen and then invest into IDR or INR denominated assets? Perhaps, but my personal experience is that on those bonds, typically the investment is hedged in any case. So the carry doesn't quite, make that much of a compelling sense. The big story with respect to carry to India that we see is that borrow from low rate jurisdictions like Singapore and then do many, many times leverage and go in. So those who have been in the market for more than a decade might remember the FNRB scheme that got unleashed the first time India had a taper tantrum related BOP concern and had to issue a couple of $1 billion worth of bond. I think Singapore investors were the biggest to underwrite that one. Again, from personal experience, that sort of carry even continues till today. People do borrow from low interest rate, hard currency jurisdictions like Singapore or Japan and invest into high yielding assets like Brazilian bonds or Indonesian bonds and so on. Not entirely sure whether there has been a sea change in investor mindset with that regard. And our macro strategies that we have so far don't really include any of that. So I'll say the answer is a qualified probably no. We're not quite there yet. Because the monetary policy outlook is also quite uncertain. What we have seen in terms of pure flows data, which is why I was asking Philip about the flows question with respect to China, is that there has been a switch in flows. The US equity markets are not receiving the kind of flows they did in the past. Europe and Japan in particular have seen quite a bit of inflows into their equity markets. EM bonds have seen some, not a lot, some pickup in interest. Chinese bonds have been a star performer in the midst of all these sticky interest rates around the world. China has been cutting rates, and there's been a huge rally in Chinese bonds. And as you can see from this chart that we have on the screen right now from Philip's table of what has happened with USD CNY, you would have made a lot of money being long Chinese fixed income. And now that's an area where I would see global portfolio managers get more and more interested. One final question. Yen unwind trade, just as we were talking about the yen, trade probability and factors that can lead to the same. Shall I repeat that question? Yen unwind trade probability and factors that can lead to same.
Right. So I'll take that question. So I think there's a lot of scarring given what happened in July last year after the BOJ says that they could be going ahead with with a surprise rate hike. So we see a very sharp unwind in yen. But now going forward, I think market expectations have changed completely. So markets are now expecting the BOJ to be gradually raising rates. So the likelihood of a significant dislocation in markets where they are caught by surprise on the BOJ's decision, I think is quite low. And also remember that back in 2024, when the unwind happened, was that there was a lot of deleveraging. Investors were long US tech stocks, suddenly grew very concerned about US recession risk, and that pretty much led to a risk-off kind of move where stocks came off, and there's a lot of yen buying and unwind. We are not quite at a point where we could see a significant change in terms of the stock market environment. I think investors are seeing that Trump could be quite flexible in terms of his ideology around tariffs, especially if there's a negative market reaction. So investors are saying, okay, maybe there's still a lot of uncertainty, but probably, we could see a bit of backtracking whenever the stock market cracks.
But on the expectation that the BOJ can keep normalizing interest rates, isn't Japan a case of complete fiscal dominance, 240% debt GDP ratio? By not being a primary buyer of JGBs, BOJ is basically creating a debt crisis. It wants to normalize, but is it capable of normalizing given the fiscal dominance?
That's a good question. So there's definitely a lot of doubt about how much BOJ can go, because if they hike by too much, then that creates a lot of negative fiscal implications. But also at the same time, if Japan enters into in a period where inflation is on a healthy path, nominal GDP is expanding, that also brings down the debt to GDP level, given that debt is on nominal terms. So by and large, the net effect is not quite as damaging as most people would think. So yes, the BOJ is not going to be like the Fed in terms of hiking rates so quickly, but at the same time, fears of fiscal dominance, I think, is perhaps a bit too large.
Go long yen, go long Japanese equities, I guess. We have run out of time. I think there was one final question on gold-backed crypto. William, I don't really know anything about gold-backed crypto. Do you know anything about that?
Okay, so we did have some interesting questions on whether is it possible to have cryptocurrencies that are actually linked to gold instead of being linked to other assets. There are few technical issues why
So like
that's
a
not.
gold stablecoin?
Yes, basically it's a representation of digital gold,
Yeah.
linked to gold. So the problem is that it's very difficult, right? Gold is a physical asset, right? So it's going to be very difficult for any issuers to issue a cryptocurrency linked to gold because they will need to park the gold somewhere. It's going to cost money to hire security, put the gold in the physical vaults, and so on and so forth. So not a very practical idea.
Actually, it's so fascinating you say this. Years ago, maybe 4 years ago, during the Singapore FinTech Festival, I hosted Augustine Carstens, General Manager BIS, and he told me about silver-backed stablecoins in the 1600s with the Dutch East India
Oh,
Company,
that's interesting.
which lasted for 70 years. But after at one point, their revenues were not very good, and they started sort of lying about how much silver they had. And after a while, when the news came out, the entire stablecoin fell apart. So I think that sort of highlights the issues with stablecoins. The underlying asset better be verifiable, better be quantifiable, and better not be subject to any kind of shenanigans. Otherwise, it all falls apart. Okay, we're like 2 minutes over time. Thank you, everybody, for joining in. It was a very well-attended call, and thanks for all the questions. Philip, thank you very much. If you're not feeling very well, do get well. And William, thank you.
Thank you.
Joshua, good to have you with us on your day 2 of internship. Everybody, stay safe, stay healthy. We'll come back with another quarterly in 3 months' time. Bye-bye.